Get ready to dive into the world of life and health insurance with exciting, beginner-friendly training that will give you the knowledge and confidence to succeed as a future agent. This course is designed as a supplementary educational tool to help future agents better understand and absorb materials covered by qualified trainers in preparation for the California Life Health Insurance Licensing exam. This is not intended to substitute the required 52-hour pre-licensing course mandated by the California Department of Insurance. All participants must complete the official 52-hour course from a certified provider to meet the licensing requirements. This supplementary course serves only as an additional resource to reinforce learning and comprehension of the key topics in life and health insurance.
Session 2, Life Insurance. Chapter 5, the Individual Life Insurance Contract. Slide 1, Components of the Life Insurance Contract. Master these terms. Policy, the written agreement between the insurer and the policyholder. Insured, the person whose life is covered by the policy. Beneficiary, the person or entity who receives the death benefit. Description, the life insurance contract is a written agreement between the insurer and the policyholder, outlining the terms and conditions of the coverage. It includes three key parties: the insured, the policyholder, who is often the insured, and the beneficiary. The insured is the person whose life is covered by the policy, and the death benefit is paid to the beneficiary upon the insured's death. This contract establishes the legal obligations of the insurer and the rights of the policyholder and beneficiary. Understanding the structure of the contract is critical for explaining how life insurance works to clients. Slide 2, Policy Ownership. Master these terms. Owner, the person who controls the policy and makes decisions regarding it. Rights of ownership includes the right to change beneficiaries, assign the policy, or access cash value. Description, the policy owner is the individual or entity that controls the life insurance policy and has the authority to make decisions regarding it. This includes the right to designate or change the beneficiaries, assign the policy to another person or entity, and access the policy's cash value, if applicable. The owner may or may not be the insured person. For example, a parent might own a policy on a child's life. As agents, it's essential to ensure clients understand their ownership rights and how they can use them to manage their policy effectively. Slide 3, the Insuring Clause. Master these terms. Insuring Clause, the part of the policy that outlines the insurer's promise to pay the death benefit. Scope, states the amount of coverage and the conditions under which the death benefit will be paid. Description, the insuring clause is one of the most important provisions in a life insurance contract. It outlines the insurer's promise to pay the death benefit to the beneficiary if the insured dies while the policy is in force. This clause specifies the amount of coverage and under what conditions the death benefit will be paid. Essentially, it forms the heart of the contract by defining the obligations of the insurer. As agents, it's important to clearly explain the insuring clause to clients so they understand what's covered and when the benefit will be paid. Slide 4, the Free Look Period. Master these terms. Free Look Period allows the policyholder to cancel the policy within a specified period, typically 10 to 30 days, for a full refund. Purpose: provides a window for the policyholder to review and reconsider the purchase. Description: the free look period is a consumer protection feature that allows the policyholder to review their life insurance contract and cancel it within a specified period, usually 10 to 30 days, for a full refund of premiums paid. This period gives the policyholder the opportunity to carefully examine the policy, ensuring it meets their needs. If they decide that the policy isn't the right fit, they can cancel without any penalties. It's important to remind clients about the free look period so they feel confident in their decision and know that they have time to reconsider their purchase if needed. Slide 5, the Consideration Clause. Master these terms. Consideration: the exchange of value required to form the contract. Policyholders' consideration: payment of premiums. Insurers' consideration: promise to pay the death benefit. Description: consideration refers to the exchange of value that makes the life insurance contract legally binding. For the policyholder, consideration is the payment of premiums, while the insurer's consideration is the promise to pay the death benefit upon the insured's death. This mutual exchange is essential for the validity of the contract. As an agent, it's important to explain this concept to clients, emphasizing that as long as they continue to pay their premiums, the insurer is obligated to fulfill its promise of coverage. Slide 6. Grace period. Master these terms. Grace period: a set period, typically 30-31 days, after a premium due date, during which the policy remains in force. Purpose: prevents immediate lapse of coverage for missed payments. Description: life insurance policies include a grace period, which is typically 30 to 31 days after the premium due date. During this time, the policy remains in force, even if the policyholder has missed a payment. This grace period prevents the immediate lapse of coverage and gives the policyholder time to catch up on their payments. If the premium is paid within the grace period, the coverage continues uninterrupted. However, if the premium remains unpaid after the grace period, the policy may lapse. Helping clients understand the importance of timely premium payments is key to ensuring they maintain continuous coverage. Slide 7. Reinstatement provision. Master these terms. Reinstatement allows the policyholder to reinstate a lapsed policy by paying back premiums and providing proof of insurability. Conditions must typically occur within a specified time frame, e.g., 3 to 5 years. Description: if a life insurance policy lapses due to non-payment, the policyholder may have the option to reinstate the policy within a certain time frame, usually 3 to 5 years. To reinstate the policyholder must pay all overdue premiums, often with interest, and provide proof of insurability to show that they are still in good health. Reinstating a policy can be a better option than purchasing a new one, especially if the original policy offered favorable terms. As an agent, you should guide clients through the reinstatement process and help them understand the conditions they must meet to restore their coverage. Slide 8. Incontestability clause. Master these terms. Incontestability clause. After a policy has been in force for 2 years, the insurer cannot contest the policy based on misstatements. Purpose: protects the policyholder from having a claim denied after the policy has been active for 2 years. Description: the incontestability clause is a critical protection for policyholders. It states that after a life insurance policy has been in force for 2 years, the insurer cannot contest or deny a claim based on misstatements made in the application. This provision ensures that, once the policy has been active for 2 years, the policyholder's beneficiaries can rely on the death benefit being paid, even if there were errors or omissions in the initial application. It's important to explain to clients that while the insurer can still contest the policy during the first 2 years, this protection kicks in after the contestability period ends. Slide 9. Suicide clause. Master these terms. Suicide clause. If the insured commits suicide within the first 2 years of the policy, no death benefit is paid and premiums are refunded. Purpose: protects the insurer from individuals purchasing policies with the intent of committing suicide. Description: the suicide clause is a common provision in life insurance policies that protects the insurer from financial loss if the insured commits suicide within the first 2 years of the policy. If this occurs, the insurer will not pay the death benefit, but will refund the premiums paid. After the 2-year period, the death benefit will be paid even if the insured commits suicide. This clause is designed to prevent individuals from purchasing life insurance with the intent of committing suicide for financial gain. It's important to make clients aware of this provision so they fully understand the terms of their coverage. Slide 10. Policy loans for permanent policies. Master these terms. Policy loans allows the policyholder to borrow against the cash value of a permanent life insurance policy. Repayment, not mandatory, but unpaid loans reduce the death benefit. Description. One of the benefits of permanent life insurance policies is the ability to take out policy loans against the cash value of the policy. These loans do not require a credit check and can be used for any purpose. While repayment of the loan is not mandatory, any unpaid loan balance, along with accumulated interest, will reduce the death benefit paid to the beneficiaries. It's important to help clients understand how borrowing against their policy can impact their long-term financial plan and their beneficiaries. As an agent, you'll guide clients in making informed decisions about when and how to access their policy's cash value. This completes Chapter 5, the Individual Life Insurance Contract of Session 2, Life Insurance. Coming next, Session 2, Life Insurance. Chapter 6, Taxation of Life Insurance and Annuities.
Great job! Great job completing this session. You're building a strong foundation, and the next chapter will take you even deeper into the essential skills you need to master. Let's keep momentum going, jump into the next session, and continue your journey to becoming a top-notch life and health insurance agent.